All right, all right. Good morning, good morning. How's everybody doing this morning? Hopefully you recovered from the long weekend. I had a long weekend. I went down to Las Vegas, took a little time off. We're not teaching classes at the university this week, so I spent a little time down there. What a place. Holy cow. So anyway, everybody said that there's not anybody coming to Las Vegas. You see that everywhere. That's not true. The place was packed. All right, lots of people in Las Vegas. All right, so anyway, we had a good time. Went to a show, went to a buffet, spoiled ourselves a little bit. So have that little Tesla car. I bought that little Tesla car, and I live here, of course, in St. George now, and drove that thing drove us all the way to Las Vegas. Never touched the wheel the whole way down. Got down to Las Vegas, drove us all over Las Vegas in the city. Never touched the wheel. One time it tried to sneak in, you know how a lot of people stack up to go on a turning lane and it's like really long. And so the little car came up and was like, oh, you know what? It didn't realize that the cars that were back here were trying to get into the lane to turn. So it goes up and it tries to sneak in, tried to butt in. And I'm like, yeah, I can't do that. That's kind of rude. So I had to turn it off right there. And then it rerouted me kind of a funny way. And I told it to reroute again. And that was it. That's the only time I touched the wheel the whole trip, all the way down, all the way back. It drove me everywhere, all over Las Vegas. It just took right over. Las Vegas, it's dirty streets and construction everywhere and little cones and people standing with signs, and it did it all. It was just amazing. Amazing. So I had a really good time with that. That was a good trip, and made it back home and drove me right up to my garage. So Elon's come a long way with that technology. So I'm a big fan, and of course that's why I own the stock, right? I mean, actually, I don't own much Tesla, believe it or not. I do have a little bit, and where is Tesla in here? But I have TSLY, which is of course the options version. So we trade options on Tesla, and I do have a lot of that. So that's the fund right there. That's Tesla, TSLY. And I actually ordered the license plate, TSLY, for my new Tesla car. That's pretty funny, right? But it hasn't shown up yet, and I don't know why. I ordered it a long time ago. I also have PLTY. PLTY is the license plate for my other car, for my little Audi. So I have a PLTY, and I ordered TSLY. Maybe somebody else has it, and they're like, sorry, you can't have that one. But they didn't tell me, so I'm still assuming that it's on its way. Anyway, hopefully we're having a good morning. A lot of people in here saying good morning, so it's nice to see you guys. So everybody saying good morning. Happy Veterans Day for those of us who served a little bit. I didn't serve. I can't say us, me, us. Us is in all of us Americans. Happy Veterans Day to those of us who served. And then good morning, good morning, good morning. Happy Veterans Day. So my father served. He was in the Marines, believe it or not. I have some friends. My uncle served. Got some people who served in my family. A lot of people in my family have served in the military. Got a lot of nephews and nieces who have served. So, oh, that was that was a mistake. That went down the wrong throat. Take a drink of water. All right, here we go. What we're going to do today is we're going to do a little bit of discovery. Oh, hold on a second. All right, what are we going to discover? We're going to discover some of these ETFs that we want to put into our portfolio. So we're going to do a little discovery. That's what we got going today. So let's get started with that. If I don't choke myself. All right, now my eyes are watering too. Whew, water went down the wrong throat. Okay, here we go. The first thing I want to do is I want to pull up our software. And this is Portfolio Matrix. And this is my portfolio. This is one of them. And you can see that this is the one they show you in the brokerage firm. And it's going kind of been tanking since I did that rebalance. So it was a little sideways, and I got a little bit more aggressive. You can see this was pretty pretty quiet through here. My portfolio wasn't nearly as aggressive, and I made it really aggressive right here. And boy, the net asset value has gone way down. But when I did that, the you can see over here, this is the distributions. Distributions went straight up. So this was the rebalance. I was doing pretty good in here. Felt really good. It's coming up. Then I rebalanced, and then it shot off like a rocket ship. Look how much better I did. But now this last month, towards the end of October, going into November, we've not been doing well. The market's been coming down, and none of these stocks been able to keep up with that drop in the net asset value. I think a lot of that has to do with the stupid Misty. I'm hanging on to that piece of crap. I don't want to call it a piece of crap because it's still making money. It's just not. It's a tough one. I don't know. I got a lot of money in Bitcoin, and that's the biggest problem. Is my portfolio is heavily weighted towards a lot of Bitcoin. I had a lot of hope in Bitcoin, and it's not been performing well this last couple of months. And so it's been dragging my portfolio down. I have high hopes for it, though. I do believe that the administration is working on building up that. Got some new news, some inside news from some guys that inside news. It's not inside news. Anybody can do it. It's not inside trading. No news that way. It's just a couple of guys that I trust are saying that they believe that the administration is working on setting up that federal fund for Bitcoin. They're going to be doing they think they're going to be doing some quiet purchasing. But I do have Grok, and Grok tells me every now and again. Actually, I have it set up to automatically check. You ever done that with Grok? You can go into Grok and you can say, okay, every week I want you to check and see if what's going on here, and it'll send you like a little newsletter, and then it'll give you details of what's going on. And one of the things that I have it check is how often the biggest banks and hedge funds are buying or selling Bitcoin. And for the last couple of months, they've been selling. So they started selling about towards September, October. They started selling some of their Bitcoin. That was kind of freaking me out. I was like, oh, I've got a bunch of that, and they're selling it. But now they started buying. So they're quietly starting to buy Bitcoin again. They think that the Bitcoin Reserve, federal government Bitcoin Reserve, I think is going to be something that's going to be taken off here. So hopefully our Bitcoin markets will turn around and go back up, and that'll help my portfolio a little bit. So again, I'm just too heavy in Bitcoin. Don't put most of your eggs in one basket like I did. It was just making too much money there for a while, and so now it's just giving a little bit back. You can see I'm not crying. I mean, look, this is where I started back here in January 2025, and look how high I am. So I'm not crying that I'm losing a little bit, giving a little back, but I am crying. I don't like to see it come back. So anyway, nonetheless, that's what we're going through right now. And I think that those of you who still holding a little bit of Misty, we still got some hope. I got a little bit of, you can see I got BD in here, which is a combination of Bitcoin and I think Ethereum. And then, of course, BITO. And BITO is just straight up a Bitcoin ETF. And apparently the bank that's holding this one, I think it's Chase Bank. Or is it Chase that does this one? Pro Shares. Can't remember who's manages this one. But this one is, they're starting to buy that one back up again too. So they're putting more Bitcoin into that BITO BITO thing. I got $85,000 in there in BITO current value. So I'm still making money on it. It's okay. I'm at $33,000 up, so that's good. I just don't want it to go down as much. Don't want it to go down. Don't want it to go down. Dividends are trying to keep up with the NAV decay, and that's the problem. Just trying to keep it up, trying to keep the NAV decay going. All right. So we're going to go through and look at, do a little bit of discovery of things that we might want to put into our portfolio. Right now, Bitcoin's down, and if you want to buy some Bitcoin, might be a good time to do it. Put some Bitcoin into your portfolio. Misty would be the one, BITO would be the one, or maybe BD would be the one if you want to put a little Bitcoin in there. This is Bitcoin, a little crossover between BD and BD is Bitcoin and Ethereum. So if you're into that kind of thing, those are the ones, and they're beat up quite seriously right now. So You know, buy low, sell high. That's the name of the game. We always want to buy the good ones and not the bad ones. And the bad ones right now are Bitcoin. They're struggling. So let's go over and we're going to go look at I wanted to go and look at 3 different companies. All right. So we're going to do that. We touched on these last time or in one of our classes a couple weeks ago. And I want to go in and touch on them again for us. So the first one I want to go to is YieldMax. Now, ETFs.com is called YieldMaxETFs.com. And this is the YieldMax website. This is one of the high yield ETF companies. And this is my favorite one. And the reason it's my favorite is because I like to do, well, I don't want to really say it's my favorite because I really like the Granite shares too. Because they're 2 different, they do the same thing, they do them with different strategies. And this one is call options, covered calls, synthetic longs. So you get to take advantage of the long side of the market. If the market's rising, these funds will do better, okay, because they're selling covered calls against a long rising market strategy. If the market's falling, then they're not going to do as well because they have no downside protection other than the little bit of premium that they collect from selling the covered call to try and reduce the pressure on the downside slide, which is why you see my portfolio like this when we come back to all my open positions. That's why you see this kind of struggling a little bit. The dividends because mine is 100% coming from the YieldMax funds. So there's no downside protection if the market starts to flush, other than just the premium coming in from the covered call to try and help that cover. So, and where I'm really heavy into the Bitcoin, I think that's why I'm getting a little bit of a drift lower here. So this is the website, and this is where you can come through and you can take a look at all the different funds. So here they are. If you just hover over our ETFs, you can see these are the single stock ETFs that we talked about. So they got a lot and they keep adding more. So I update this list on our calculator every month. And so I could probably go in there. I think I just did it, but I'll go in and check it when the last time it was. But Grok helps me do that. Helps me update that list. And sometimes I have to work with Grok for an entire day to get him to figure it out again. Each time I have to. AI is going to take our jobs, but not anytime soon. All right. Still a little struggle to work with these guys. Little AI's doing good, but still struggles with just some simple things. Okay, and then these are the short single stock options. So these are the ones that if you think the market's going to go down that you'd want to be in. So this is Crush, Dips, Fiat, Winter, and YQQ. So we'd have to go see and click on them and find out which ones are covering. Crush, I think, is Dips. I can't remember. Fiat. I think these are the currencies. Winter. I'm not exactly sure. We know that's the Qs. Which ones those are covering short positions on. But that's if you think the market's really going to fall. And I did quite a bit of math on these. And the market has to really fall hard for these to pay off. It's not like, oh, I think the market might go down a little bit, and so I'm going to put my money in these. No, the market really has to crush and flush for a long period of time for these to pay off. So not real interested in these personally myself, just because the market's been so bullish lately. Of course, we're getting to the point where I'm getting a lot more scared that we are going to get a flush out. The market goes, just doesn't go straight up forever. And it's just been going straight up. So we got to be mindful of that. Now, all of them have. Misty, some of those Bitcoins have not been going straight up, and I probably would have done well to be in one of those short positions. So then these are these are just some of their YieldMax funds. So you have YMAG and YMAX. Now, if we go over in YMAG and YMAX, these are some stabilizing funds that if you put these in your portfolio is not going to make as much money, but it's going to be a lot more stable. So we talked about that in class on Friday when Ben was there, and he was saying, okay, a lot of people can't handle a lot of ups and downs. My portfolio is very much one of those portfolios that's going to have a lot of up and down. I got a lot of what right here. The standard deviation is really high. See, I got a 16.97 standard deviation. So my portfolio can fluctuate within a 16, almost 17% standard deviation. Means it can go up 17%, down 17%, and still be within its normal range. And that the higher you get on that standard deviation, the bigger the dividends are going to be. And I'll show you why. All right. Because when you come over into your portfolio and you go into, let's say, Tesla, for example, we're going to go to Tesla. And now Tesla looks like it's going to, hate to say it, looks like it's going to have a little bit of a pullback here. So when you go into Tesla, the way that, now remember, the way these guys are trading is they're doing options. And so when you come in and you look at the options chain, now this is how you price out options. All right, so this is track and trade, and this is the options chain right here. And when you come over and look at this number right here, implied volatility, see implied volatility, anything generally considered above 50 is considered pretty high. All right, so right now Tesla is the implied volatility. Let's go out a little bit farther. Let's go out and do some 38 days. These are pretty standard. Implied volatility is at 54. Now that's not super high for some of these funds, but it's getting up there. Implied volatility means that people are a little bit nervous about this market, and that's how they price out. That's actually how they price out the options that they're selling. So the higher that number, the more expensive the option. So you can see the options premium right here. This is how much people are paying for their insurance policy. Remember, if we think about this as an insurance policy, it's like, well, this is a call option too, right here. So they're selling these call options as if people think the market's going to go up. But I don't think a lot of people are thinking the market's going to go up, which is why implied volatility is down around 54. This is usually higher. We'll see implied volatility on Tesla up around 70, 80. Some of these markets, hold on a second. Some of these markets will get up over 100% on their implied volatility. And implied volatility is how these options for these yield max funds are priced out. Because the higher the implied volatility, the higher the premium. So the premium is how much somebody has to pay the insurance company. All right, the insurance company being yield banks at this point, because they're the ones who are selling these options. And then of course we're the insurance company because we're part of yield max. And so they sell the insurance company, sell the $3,000 is the money they collect, and then they share that, they give it to us, right? So that's how that works. And the higher this number, implied volatility, the bigger this number is. So that's how come you can get so much money doing this, because they're selling these right here. They're collecting $3,000 when somebody buys one of these options. Now they're selling the ones that are a little bit further out of the money. So there's not, that's at the money, 3,000. They're selling these out here. They're probably selling them out in here, 2,400, 2,200, but they're selling a ladder version. So they don't just sell one. They'll come in and they'll sell this one, 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 and they'll sell that one, and they'll collect those, and they'll do a whole bunch of them. So whenever people want to, and the reason they would buy them is because they think the market's going to go up. All right. So you see the probability of the market going up is only 50, 53%, 55%. Well, that's out of the money, in the money. So you can see the probability of those markets going up right now. That is only 44% chance the market's going to go up. 46%, 49%. The closer you get to where it's currently trading, right, the higher the chances are the market's going to go up. So this is the options market, and this is the options chain, and this is how you understand options. And so this is just going to be a shameless plug that in the first week of December, I'm going to be teaching an options class, and I'm going to go through and teach you how all this stuff works so you can understand what you can do it for one, so you can do it yourself. You can come in and buy and sell options, and that's a good thing to do. And I'll show you how to do some strategies to protect your portfolio or to increase the size of your portfolio by buying options, right? Or you can sell the options and collect the premium, just like YieldMax does and just like Granite Shares does. Now, Granite Shares does the other side. Okay, so if we go over and we look at Granite Shares, let's jump back over here. Is that the one? No, right here. So we're going to jump back over here. So if you go to Granite Shares, and I don't have any Granite Shares in my portfolio, so we're going to go to their website. We're going to come over here. Granite Shares, they actually, if you look at their ETF list, and it's the Yield Boost, that's the ones we're interested in, Yield Boost right here on the Granite Shares website. And you come in here, these are the ones. Now, this is crazy. When I first started doing this about a year ago, they only had 4. Now, look how many they've added. So these guys are going crazy. They're popular. See, oh, look, they've even got a popular. I'm popular. Okay, and this is Nvidia. This is Coinbase. This is Tesla. So now what these guys are doing is these guys are actually selling put options, not call options. So they're protected to the downside because what they do is they sell a put option and then they buy a put option. So they do a little spread, all right? And that's how they're trading options and collecting premium to make the money that they're doing. So let's go into, they're doing TSYY. So let's go over and we'll pull up TSYY in our charts. TSYY. And this is TSYY. Now it's going down, but that's the yield, because if we got to remember, we want to also look at the not just the not the yield. This is not the yield. This is the growth. The reason the reason it goes down is because they're giving you all of the growth. They're giving you all of the money they're making, and so it keeps going down. So the yield has to outperform the NAV loss, and that's what I'm running into with my Misty right now. Is that the NAV loss is quite significant. Now the yield is still paying for it and still making money. It's just not as much as you would like, right? So come over here and look at the implied volatility. We're going to go to, again, to Tesla, not TSYY. We're going to go into Tesla, because every time you do anything with yield max funds or Granite Shares funds, you always want to watch the underlying stock. You really don't really care about this one here. I mean, we do. We care about it, but because that's where our money's at. But really, all they're doing is this is just a bucket we're putting our money into, and this is where our bucket sits. And then they go over and they make their money off of what's going on over here. So this is the one we really want to do all of our analysis on. So we come over here and we say, well, I think the market's going to fall. Well, that's not going to be good for this market, because, you know, or for this market, because the market's going to fall a little bit. Market goes up, you make more money with the yield max funds. Now with the Granite Shares funds, doesn't matter whether it goes up or down. They're going to make the same amount of money one way or the other. Well, that's not necessarily true, because they sell put options, all right, but they protect themselves with another put option. So let's come in here and do put options. Now these are calls. We come over and do puts, you can see they're going to sell the put options. Now this is how they do it. They come in here and they say, okay, I'm going to sell these put options, and the implied volatility again is determining how expensive the options are. And you can see the put options right now at the money are 65%. Now remember, on the yield max funds, the call side, the call sides were only at 55% at the money, right? Let's go look at the calls. The calls 38. Oh, this is TSLY. We're on the wrong one. You got to be on this one. Sorry. Go to the TSLA, and then we're going to go to calls, and we're going to go to call options, and you can see there the implied volatility is 54. And it's the same as very close to the delta, but we'll talk about that again in another class. So 53 is your implied volatility. And we're going to go to the put options, and the put options, the implied volatility is 50. So you're actually getting a higher implied volatility on the call options. Okay. So that's how they determine how expensive the premiums are. And then that determines how big the dividends are that they pay out. So when you go over here, now we have to go over to one more spot. This is all the background stuff. It's all good to know. You want to know all this stuff. You know, I mean, you can just go in and buy the shares and sit on them and say, well, Lion said he's got some Tesla. I guess I'll hold some Tesla too. But you kind of, you know, teach a man to fish or show a man how to fish, right? It's that thing. So the idea is to kind of learn some of this stuff yourself, just so you can understand what's going on and how they're doing what they're doing. And so it's the implied volatility that determines this number right here. And we're going to go over to this little tool right here. And in here, this number right here, we're going to go to TSLY. This number right here. See this little number, which is our all important number, right? Because that's how much money they pay us per month. So they pay us they pay us 14 cents per share. And that 14 cents is determined, believe it or not, by this number right here. Now that one's because it's the call option. It's this number right here. Implied volatility, 53.82, 53.79, 53.96. These implied volatility numbers are what determine. Now, it's not a one-to-one. It's not like, oh, it's 54% over here in implied volatility, therefore I'm going to get 54 cents over here. No, that's not how it works. This is just a percentage of how volatile the market is. And so they use that number to determine this number here. So if this number over here, this implied volatility number, is really high, if that number is really high, if it goes from 50 up to 60, 70, 80, that means the market's going crazy, right? I mean, it's really going crazy. Remember, when we were in class, I said we like crazy markets because crazy, scary markets are what makes this number right here, implied volatility, go way up. So when the volatility of the market goes up, gets crazy, starts moving all over the place and scaring people, that's why they come and buy insurance. So the implied volatility, of course, call options, they buy the calls and the implied volatility goes up if they really think the market's going to rally hard. So those numbers will go up. So that's what makes this number here go up. So that percentage of implied volatility is part of the mathematical model or formula that they use to determine how big this number is. And the bigger this number is, the more money we make, right? So it's all relative. So we're going to get 14 cents per week on every share we own. This one here is 11 cents. This one here is 16 cents. So see, implied volatility was much higher over here. And then this one here, 19 cents. So that's how it's like, oh, well, implied volatility must have been really high. Okay, because we got 19 cents here as opposed to right here, things are calming down. We're only getting 14 cents. Well, that's because the market over here has been drifting sideways, and less people think the market's going to go up. If you get sell signals right here, well, implied volatility is going to go down on the call side, but that means implied volatility will go up on the put side. So if you come over now and we go to the Granite shares TSYY, and people think the market's going to go down, that's why we should get a little bit higher numbers here. See, this is 20 cents. This is 20 cents. They're staying pretty, that was 41 cents. So that means they're selling lots of put options, okay? Getting scary. Implied volatility is going up, okay? So now we're going to come over here and we're going to look at the put side. So this is the Granite share side. This is what they do. They sell these. They sell the pink ones. So Granite share sells the pink ones, and Yield Max, they sell the blue ones, all right? So you've got both sides of the coin. So this one here, you can see implied volatility is at 50. So pretty close to about the same thing as what they're getting on the blue side. But it looks like to me, the blue side, a little bit higher, 54, whereas the put side is a little bit lower. So they're selling these things right in here, implied volatility. And so the strategy that the Granite shares does is they sell put options down here as if the market's going to fall. So they're protecting. People buy the put options thinking the market's going to fall, and that would protect them. So they make money when the market goes down. So if they think the market's going to go down, they're going to buy put options because they think the market's going to go down. It's going to protect their portfolio from loss, right? And then the covered calls is people think the market's going to go up, therefore they don't think it's going to go up a long ways. They just think it's going to go up a little ways, so they'll sell a covered call up there to collect some premium, but they think the market's going up. So that's the side of the two sides of the coin, and that's why we like both, all right? Because the Granite shares, they do the puts. So if you think the market's going to go down, probably better off being in the pink side in the Granite shares. If you think the market's going to go up, probably better off in the blue side, which is the call side, and that's the Yield Max funds. Now, we can come in here and we can do our simple math, and we're going to go compare these two against each other, and we're going to come in and let's write down the numbers we need, and we're going to go take these numbers in, and we'll show you over in our little calculator, and then we'll go put them into portfolio matrix. All right, we'll build I'll show you how to do this. So what we're going to do is we're going to come in and for right now, we got Yield Max. Again, we're going to build a portfolio. How do we do it? This is how we do our discovery. We're going to come in here, and these are all the ones we can choose. So we're going to do, this is the strategy. This is the technique that you're going to use to decide which one of these you want to put into your portfolio. Right now, we're going to check out TSLY. We're going to write down TSLY. And we're going to come over here to this little guy right here. And we're going to say TSLY on the very last time, it paid me 20 cents. So I'm going to say 202, and that's that was the most recent dividend. Most recent dividend. That's our MRD, most recent dividend. Okay, so our MRD is 20 cents. And then the share price on it right now is at about $6.95. $6.95 to buy one TSL. Oh, this is TSYY. So I got to change that. TSYY. Okay, TSYY. So 20 cents on the MRD and $6.95 on the share price. Now we're going to go over and we're going to pull up the TSLY. So that's the put option version. This is the call option version. So the last one on this one, again, we'll look at that's 14 cents. They did 11 cents, 16 cents, 19 cents. This is back when they were doing a monthly, 80 cents, 39 cents. That was low. 30 cents, 38 cents. Oh, like I said, 30 cents is pretty typical. That's the high one that they did, which was a reconciliation before they went into weeklies. So 19 cents, 16 cents, 11 cents, 14 cents. Okay, so we're going to do most recent. So we're going to go TSLY, and this is for the long side. So it's long, meaning, of course, market. We think the market's going to go up. So 147 on the MRD, most recent dividend. And then the share price is $8.16. $8.16. Okay, so we got those numbers. We got those numbers written down. And so now we're going to go over to our little calculator. So we're going to go over to our little Pitt News Magazine calculator. All right. And we're going to compare those two. So we're going to come in here and let's clear those out. The ones that we had in there from before. Oh, they didn't clear them out. How come I didn't clear them out? There we go. Cleared them out. Okay, so we're on the dividend calculator in our Pitt News Magazine calculator. For those of you who don't know how to get to this, you just go to pittnewsmagazine.com or pittnews.com because you all have the Pitt News Magazine, right? Everybody here has Pitt News Magazine. You're all subscribers, right? I know you all are here. In fact, if you're not a subscriber of Pitt News Magazine, why not go over and do it right now? Here's the QR code.
Ready to level up your news game? Welcome to Pitt News Magazine, where stories come alive. Read it, hear it, or watch it in our YouTube classroom. Right now, get your first 2 issues for just $1. Yep, only $1. Don't love it? Cancel anytime before the $39 yearly fee kicks in. Try it out, risk-free. Satisfaction guaranteed, or your money back. Visit pittnews.com. That's pitnews.com, Pitt News Magazine. News your way.
Of course, that's not a printed magazine. It's a digital magazine. All right. So that's how you get this calculator. You have a subscription to Pitt News Magazine. Or you come to the class at the university. That'll get you this too. So we come in here and we're going to go in and we're going to put this into TSYY. All right. And then over here, TSYY, we had a share price of $6.95. And we had a dividend of 0.202. And that pays out weekly at that rate, weekly. And then we have this one, which is TSYY. And we're going to compare it at a share price of 8.16 and a dividend of 0.147. Did I do everything right? Check my work. Okay, the weekly. And we're going to put in, let's just say $10,000 and calculate and compare. Okay, so right now we're seeing that we're getting an annual dividend yield. Most recent dividend is 151% versus annual dividend yield of 93% on the TSYY. So this is the calls. This is the puts. All right, so weekly, you'd be getting $290 on your $10,000 or $180 on your $10,000. You're like, well, Lan, why do you have this one when you could have that one? Well, I used to have some of this one, and I rolled it into this one. Doesn't mean this one's bad. It's not. It's good. I put some more in there. Be happy with it. Very much so. I should probably have some. All right. I tell other people to put their money in there. I should probably have some again. But when I did my rebalance, and you guys all know we come and do our rebalance here in our target programs, right? This is where I did my portfolio, and I had TSYY in here, and it was too volatile for my settings, and it told me to take TSYY out and replace it with something that wasn't quite so volatile, because my standard deviation was getting really super high. All right. And so that was the one of them that it recommended I take out. So I did, I took it out. And then that was just to calm down my portfolio a little bit because it was just getting really volatile. All right. And you can see from this portfolio matrix. So as you come over here, you can see that I do have a pretty volatile portfolio, 16.97. My target right now is at 15.24. You can see that down in here. And these are the ones I've gotten. I've taken, these are the actual stocks. NVIDIA, I've taken that out. Tesla, I've taken that out. And so that's just comparing these right here. Okay. So that's how that works. And you can see I've been a little flat this month. So far, a little flat. I need another couple of dividends to pop in here and have that green line pop up. I need some pop-ups. All right. 4 months away from having a cash cow, meaning having my dividends pay me back enough money that it's paid back 100% of everything I put in. 4 months away, and I'll have a complete cash cow in my portfolio. I'm pretty excited about seeing that happen. All right. So that's just a quick look at my portfolio. So you can see I'm making, this is in October, this is the running total. I'm up 281,000 so far on this one UBI position, this one portfolio. I got several portfolios in here. When you combine them, it's more than that. But just this one, I'm up to at 281. And then this month, this one is making 43,000. So that's real money. That's real money right there. Okay, this is my real money portfolio. I'm not showing you a demo account. This is the real thing. So as we come in, we're going to come back over here to our little targeter. I think we're using this one. Oh, we're using this one. So that's what we did with TSYY and TSYY. So if you wanted this one, it's going to have a little bit higher implied volatility, right? It's going to have a little bit bigger premiums. It's paying a little bit more money, but it's going to also have more fluctuation in the standard deviation. So but that's a good one, TSYY. Let's put that into our portfolio. How are we going to do that? Let's come over here to our portfolio matrix, and let's come down here, and I'm going to create a new one. So we're going to come in here, and we're going to say a new group. So we're going to add a group, and we're going to call this our UTU, Utah Tech University portfolio. And we're going to put into it, add new symbols. We're going to put in there TSYY. And is that the one we're going to choose, TSYY, rather than TSLY, the put option version? Okay, we're going to do that. So we're going to create the portfolio. And of course, you could put a whole bunch in there right when you create it. But right now, we're just going to create them, put them in there one at a time. So here's our UTU portfolio. Right now, we have TSYY in there. All right. And it's got a little ghosty by there because there's no real money in it. This one, I already have real money in there in both a Chippy and Soxy in my portfolio up here. I don't know why the little ghosties are there. That's because I just did them, but I think I've had money in there. So those little ghosties should go away. But right now, this one here has a little ghosty because there's no money in it. Okay. So this is our portfolio. And we're going to come over here and we're going to go do some more discovery. So now we're going to go back over again. We're going to go look at the Granite shares. We're going to say, what other do we want to do in here? Now, I've done almost all the work for you on this, okay? And that's why we come back over here. We're going to come back to this one, the little Pitt News Magazine calculator. We go to the investment calculator, and we're going to go in here and we're going to say, how much do I need to invest? How much income can I earn? I'm going to put in that if I have $10,000. So we're going to go $10,000. We're going to go calculate. How much money can I earn? And this is where we've got all of the Granite shares and the Yield Max in there. Now, one thing we don't have is we don't have the Round Hill. I need to get the Round Hill ones in here because we got those three companies that we really like, okay? Granite shares, Round Hill, and Yield Max. And those are the three companies that were with these high yield ETFs. Now, we can come in. Now, don't think that you can't come in here and say, okay, we're doing all this high yield stuff. It doesn't mean you can't come in here and say, I want to go over to my UTU portfolio and I want to add to it. See, we're going to come in here and we're going to add. We can come in here and TSLA. We can actually put, You know, I mean, why not? You can put some TSLA in here. Now, there's no dividends, but it's got growth. See, right now, the last year, Tesla's grown 35%. So if you want some Tesla in your portfolio, or if you have some Tesla and you want to add it to your portfolio, you just pull it up in this little program like here, and you slide down here, and here's our UTU portfolio. It says add TSLA, so you click on it, and there you go. It's adding TSLA to your portfolio. So you don't have to have just the yield max funds. So now we have TSLA and we have TSYY. So when we come over and we're like, okay, well, what's our asset calculator? No, we want to do this one here. So now we come over here and set our stats. You can see that when you apply your performance based on price gain, this one here is, let's do, that's $1 million. I was doing 1 million. Let's do 10,000. And we're going to say we're going to do equal outcome, equal diversity. Let's just go relative performance based on price gain plus yield. Because we're going to do just those two. So now it's telling us that we're going to put 35% into Tesla at $4,400 of our 10,000, and into TSYY we're going to put 43% so that we can pick up some dividends. So we got growth and dividends. See that? That's what we were saying the other day when we were talking about being able to do both, not just TSLY or TSYY, but we can also include some TSAA and get some additional growth in there. So in this case, it says we can do, if we're going to do combined gain and yield, we're going to put in here, see, we're going to have a negative 23% on our gain, but that's all coming from TSYY, and our annual yield, which is all coming from TSYY, so our negative, but we got a positive TSLA on the gain. So our gain, our positive gain, that gives us 40% return, annualized return on our money coming from both TSYY and TSLA. So we can get some of that big gain and then get that big dividend by combining the two, TSYY and TSLY. See that? So let's go over and do one more. Let's come over here. And we're going to come in and we're going to go down, and I want to find another really high one. These are all the shorts because there's several markets that are doing shorts right now. There's Tesla, there's Bitcoin, AMD. Look at AMD right there. That's a pretty good one. I want to come down and do PLTY because I really like PLTY. I have a lot of PLTY. Palantir. So let's go do PLTY. All right. So we're going to come back over here and we're going to go into do we want to compare? Well, these are all compared already. So if we want to compare something like, where did the AMD? AMD right here is coming in at the yield is 101%. That's a high yield. And then the 6-month gain has been at 44%. The yield plus the gain is 146%. So that's monthly on a $10,000. That's $846. That's a lot higher than the PLTY, which PLTY, now PLTY used to be at the very top of the list. So when I put some in, it was at the very top and it's come down a little bit. So why don't we go over and look at PLTY? We're going to come over here and pull up PLTY. Now, PLTY being at the top of the list when I did it doesn't mean that it's PLTR. Doesn't mean that the stock is falling. It means that the implied volatility has gone down. So you can see that the implied volatility was really high here. And then lately, the market's not been going up like that. It's been going sideways. All right. So that market going sideways like that, the implied volatility has gone way down. So here we go. Let's go out and look at the 38 days again. And you can see that we're at an implied volatility of 54. Well, that used to be an implied volatility. We can come and see if we do this little indicator right here in track and trade. We're going to look at, where is it? Historic volatility. So, oh, it's going up. So it's been higher. See this? See how high historical volatility? Historical volatility is way up here. That means the implied volatility. This is what it's really tracking. It's tracking the implied volatility. So implied volatility, look through here. It's been dead. Look how low it is. That's why Palantir's dropped. But now look, it's taken off. It's going back up. So implied volatility is coming back up. So that means that this is getting excited. All right, right here. This is getting excited, and we know that from the history right there. See, we don't, this number, implied volatility, only tells us one number. It only tells us what it is today. This number tells us what it's been in the past. Okay, so this is where you're going to get big premiums, big payouts. Your implied volatility tells you when you're making a lot of money, but this has been really quiet lately, and so the dividend numbers been going way down. Now the dividends are starting to go back up, so this will be good. These coming back up above 50% again. This means people are getting nervous. All right. Well, actually, not so much. Let's go look at the puts. 55 versus 51. Yep, they think the market's going to go up. It's got a little bit of a bias to the upside by about 5%. See, if you have implied volatility on the puts higher than the implied volatility on the calls, that's a little bit of a bias to the downside, meaning that put options are more expensive versus this one here, where call options are more expensive. Then that means that the bias to the market is about a 5% to the upside. About 5% more people think the market's going to go up, if you want to think about it like that. Not exactly, but that's kind of, if you want to think about it like that, that's kind of how you could look at it. You say, well, about 5% of the people, because you got a 50-50 market, right? So if more people, the implied volatility is higher to the call side, that means more people are going to be buying calls. So they think this market's more likely to be going up. All right. So that's what that means. All right. So we're going to come back over here. So let's do Palantir. We're going to go in, and Palantir is a good one. I like it. So if we can find it in here again, where did Palantir go? There it is right there. 61% is the yield, and the 6-month gain is 0.30. So that's been almost nothing. So a combination of yield plus gain is 62%. 62% return on your money is pretty darn good. If you went down to Cash Valley Bank, put your money in there, and got about 5%, which is probably hard to do right now. You probably can't even get that on a long-term CD. You'd be 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60. You'd be basically 11 years to get the same amount of return as you're going to get in Palantir in 1 year. Okay, that makes sense. All right, that's how it works. So let's come back over here, and we're going to take these numbers. Let's just go put it right into our portfolio, PLTY, and while we're there, we're going to add AMDY. All right, so we're going to come over here. Actually, we're going to come over here, right here, and we're going to come in, and we're going to go in, and we're going to search. We're going to go AMDY, and we're going to go AMDY, and we look at that. We go, oh, we love AMDY. Look at that. The gains, oh, well, negative 26, but we have a yield of 73, so we're getting that. There's that 47% return. Now, if we come down here and look at this number, you can see the annualized yield is 68%. Okay. See down there in the bottom, the little 68%. So the way that works is, if you don't want to do your math, right, which most of us don't, remember, we come over here and we go into AMDY. We don't need to really do that because we got it in Portfolio Matrix. AMDY. And so I do this just for the lesson, right? So the math is there for you. So now we come over and we do our math, and we say, okay, we got 12 cents is what AMDY is paying, and we do it multiplied by 921 divided by 10,000. If you've got Portfolio Matrix, you don't need to do all that math because it just comes over to Portfolio Matrix, and it's right there. I'll calculate it out for you. That number ends up being 68, all right? So annualized rate of return is 68. If you come back to this one, you can see it was 122. Wow, that was last week. This one here is 104. This one, now this is the 500 annualized return. Oh, that's because they're going the difference between the weekly and the monthlies. 166, 163. So these are the ones that we're looking at right here. 122. That one right there. 68% return. Distribution 12 cents. All right, so you can see it up here in the chart too. This is the better way to look at it right here. So you got a gain on this is over from the last year, for over the whole year. All right, these numbers down here are just the one dividend. All right, so you're seeing 26% down. So the AMDY went down 26%, but they had 73% on the yield. They had a standard deviation, so it fluctuated 15% up and down throughout the year, and then it had 73% return When you subtract the discount here on the gain against the yield, you get 47.22. All right. Now remember, when this works out, you're like, well, Lan, how do I, 47% is good, but I want more money. Well, think about it. Remember, you put your $10,000 into the market. You don't have to realize the 26,000 until you take it out. You get to realize this every single month. Okay. So, or every 73 is annualized, but divided by 12. So you get to realize see, that's when we come down to our dividends. We get the dividends every month, but the market's sitting there with our $10,000 and it might go down to $1,000, but we don't lose that $1,000 until we sell it, right? And so we get the dividends, we get the 73.71%. We get to go spend 73.1%. Well, when do we have to realize this? 26%. The 26% is based on the $10,000 that we put in, right? So we got basically two numbers going here. We put $10,000 in, and it's gone down over the last year 26%, but it's still sitting in the market. So it's no longer $10,000. It's now $8,000. Okay. So that $8,000 is sitting in the market. And we still have the same number of shares, and they give us the yield based on the number of shares we have. So the $10,000 is still sitting in the market, and it now says your little phone or whatever, you go to Track and Trade or whatever, it tells you that, hey, that $10,000 you put in is now only worth $9,000 or $8,000. And you're like, okay. But in the meantime, you every month got this big 73% dividend that you got to go spend. Now, if you want to cover that loss, you can take $2,000 of the yield and put it back over there and bring that back up to 10,000 if you want, if you care. Why do you care? I mean, it's down 2,000. It may come back up, right? The market might have a big rally and that'll come back up a little bit. But really, that's not the big concern. The big concern is how much are you making here? How much money are you getting on the yield? This 10,000 is sitting over here giving you this yield. I'm getting 73% that I can go spend. I can go buy things with it. Is one of the things I want to buy is comfort in having this be back to 10,000 again? If it is, take 23% or 26% of everything they give you here and put it back into the market. So that's always $10,000. It'll give you more shares too in doing that. Bring that back up to $10,000 and it'll give you more shares, and your dividend, your yield will be a bigger dollar amount next time too if you do that. So the way you do that is every time you get your 73% in dollars, you take 26% of it and put it back into the market to cover the gain to keep that at 10,000, and it's going to give you more shares. And you're not going to spend the full 73%, but you're going to get 47% to go spend. That's yours. Go spend it. If you care about this money over here, 10,000, always staying at 10,000. But if you don't care if it goes down to 9,000, what do you care? I mean, the $10,000 that's in the market, you still have the same number of shares, just the share value went down a little bit. Okay, well, if you want to keep that at 10,000, you can just put the money back in. But otherwise, you just take this money and you go spend it. And then I always think, well, when am I going to realize that loss? Well, depending on your age, you're going to realize that loss when you die. And so now your kids are going to realize that loss. All right. Your kids are going to say, well, grandpa's got or dad's got $8,000 in the market. They're not going to care that you used to have 10,000 and that it went down 2,000. They're going to say, dad's got $10,000 in the market, $9,000, $8,000 in the market. Let's go take it out and spend it. Or if they're smart, they'll leave it in there and take the 73%, right, and go spend it. But you don't ever have to realize that $2,000 loss if you don't want to. Now, over time, it could go down to a $3,000 loss, a $4,000 loss. So you might want to supplement a little bit over time. Yeah, put some money back in there, keep that up there, But really, you don't have to if you don't want to. I mean, you've got the shares. It's irrelevant what you paid for them. That's what you paid for the shares, and it's going up and down. But you're getting that dividend coming in every month, and that's what you're living off of. So if this goes up and down, it started at 10,000, it goes up to 11,000, goes down to 9,000, goes up to 12,000, goes down to 5,000, goes up to 14,000, back down to 10,000, and sits there and fluctuates. You don't ever realize the gain of it because you don't ever sell it. So if it goes from 10,000 to 11,000, what are you going to do with that extra $1,000? Nothing. Who cares? You don't care about the growth of it. You don't really care about the drop of it. Now, we care about the drop of it a little bit more, obviously, than the growth, but the growth doesn't really mean anything to you because you're not going to ever sell it, so you're not going to ever get it. The only thing you're living off of is these yields, the dividend coming in over here. So the little bit of money that's going up and down on that 10,000, that $10,000 you put in goes up or it goes down, it goes up, it goes down, it goes up, it goes down. You don't ever realize any of that because you're not going to ever sell it. You're just going to sit here and take the money that's coming to you. But yeah, Lada, what if it goes down to 1,000? Okay, it goes down to 1,000. You put 10,000 in, it goes down to 1,000. You could put some more in to try and prop it up, but then that'll give you more shares. What'll happen is if it goes down to goes from 10,000 to 1,000, is that your yield will not be 73% anymore. Well, it might still be a high percentage, but it'll be a smaller dollar amount. All right, because it's based on percentages. So 73% of 10,000 is more than 73% of 1,000. Make sense? So that goes up and down, and it's going to fluctuate the yield value. But really, you're just living off the yield, and then you don't realize the gain or loss on the 10,000 until you sell it. That's why we talk about a cash cow. A cash cow is when you've received enough yield that this is no longer relevant. You put 10,000 in, and in 1 year, right, or a year and a half, this thing's giving you back $10,000. So now you're at what we call a cash cow. You're on the gravy train, meaning that you have no out-of-pocket risk. It's already given you all $10,000 back, and you still have your 10,000, or maybe it's 9 or 8, or maybe it's 10, 11, or 12 over here. This money is still sitting there, and it's gone up and down, but you've received $10,000 back already in 1 year. Now what? You have no out-of-pocket risk. I call that a cash cow, and you're on the gravy train. All right. So now everything that comes to you after the 1 year is free money. It's just gravy train. You don't have any risk at all. And then you got your little 10,000 over here that's going up and down, and you're freaking out all the time. Oh, Mom, my 10,000 went up and down. So what? You've just received 10,000 over here. Plus, now in the second year, you got another 10,000. And then, oh no, this is going up. It's gone down to 3,000. It's gone up to 5,000. Oh no, now it's gone up to 14,000. Now it's gone up. Who cares? You're sitting here living off the gravy train now, right? All the money coming in on the yields. That's what we call it. That's why we call it the cash cow. So you're sitting there freaking out over this little blue line right here when all the money's coming in on the purple line, and you're living off the purple line. One day you might have to realize the loss or the gain on that green line. Okay, well, I don't realize it until after you're dead. Who cares? When you die, then your kids can realize that gain or loss. But this one here's the one you want. This is one that gives you all the money. You're going to live off the gravy train. So just live off the gravy train. Don't worry about the train itself. All right. So we're going to come down here. This is AMD. We're going to add AMD to our portfolio. So now because we pulled up AMD in this window, we can come down here and it'll show up right here, and we can add AMD. So we'll just click that, and it's going to add AMD. All right. So let's close this so that we're not looking at all these long windows. Okay, so now we got our UTU portfolio. We got TSYY in there. We got TSLY. We got AMD. We're going to put PLTY. Actually, let's put a little AMD in there. All right. We're going to stabilize that up and down. You'll never realize it if you don't sell it. But if you want a little bit more stable standard deviation, oh, that's a pretty wild standard deviation on AMD. It's at almost 30%. That thing moves, boy. That baby moves. All right, so that's giving you a 69% return in the last year. So we're going to take some of that. We're going to add it to our portfolio. So we're going to add AMD. So now we got a little AMD in there, not just AMDY, but AMD. So, but remember, the way you have to make money on AMD is you have to sell it eventually, or you don't realize any of those gains because there's no yield off of this. See that yield? Zero. So the only way you make money on this one is that's the one that's going up and down all the time. So you got to realize your profits on that one. The only way you're going to realize your profits is if you sell it. If you sell it, you no longer have the shares. Keep that in mind. All right. So now we got a little AMD. We got a little AMDY. We got a little TSYY. We got a little TSLA. So we got both of each one, right, in our portfolio. Now let's go do Palantir. PLTY. And we looked at Palantir. We like Palantir. Look at Palantir. See, you put your $10,000 in at the beginning of the year, $10,000, it's done nothing. It made 1.82%. But look at the yield. 87%. Holy cow. This one turns out to be our very best one, right? Why? Because the yield, the gain was nothing. It didn't go down, but the yield was really high, 87%. So Palantir ends up being 89.33%. Well, I like that. Let's go ahead and add that to our portfolio, lad. All right, I will do that then. Okay, so we add that one to our portfolio. Well, I want a little PLTR. I want the actual underlying stock. Okay, well, put some of that in there then. And that's what it's done, 223% last year. If you would have put your money in PLTY or PLTR in the very beginning of the year, 12 months ago, you'd be up 223%. Now, did you know it was going to go up 223% a year ago? No, or you would have done this. But since you didn't know it was going to go up 223%, you didn't do it. Well, if you think it's going to go up another 223% next year, you would do it now. Do you think it's going to go up? Well, it might, but I don't. I'm scared. I don't want to put all my money into it. I don't know if it will go up another 223% next year. Okay, well then put some into TSLY, and what they do is if it does go up, well, they'll just keep giving you the profits as dividends throughout the year, right? That's, you get all your little, remember the little picture I used? You get your little pots of gold every month as opposed to one big pot of gold of 223% at the end of the year. So all they're doing is they're just taking profits along the way, giving them to you every month. Well, that's cool. All right, we like that. Still have a pot of gold at the end of the year, but you've received it throughout the whole year instead of one big pot of gold at the end of the year. Now, if you take your pots of gold at the end of every month, it might not end up being at the end a whole 223%, right? It's not as big. Why? Because you didn't take as much risk. Okay, so now we've got PLTY. We're going to add that one. We're going to add that to our portfolio. So now we've got a combination. We got a pair of each one. We can have a pair. So we have some Tesla and we have some Tesla. We have some Tesla and we got some TESY. All right, put option side. We got some AMD and we got some AMDY. And we got some Palantir and we got some Palantir Y. So we got both growth stocks in there and we've got dividend stocks. So it's a comparison. So now we got our little UTU portfolio over here, and we can come over here to our set targets, right? And we can say we're going to do relative performance. We're going to do gain plus yield. We're going to put $10,000 in there and apply that. And now this is where we've got our little portfolio coming in, and our gain 101% and are sitting at this rate. All right. So what it's going to do is in PLTR, well, it's going off a gain. So PLTR in the last year had a huge amount of gain. So it's going to say you should put $4,000 of your $10,000 into PLTR because you said up here you want to gain plus yield. Well, we had big gain in Palantir. So we're going to assume that maybe if it did well last year, it's going to continue doing well this year. So it's going to put a little bit more money in there. PLTY is going to get $4,000 of our $3,000. And then PLTY, well, you want some dividends too. So there's 89%. We're going to put a 1,754 in there. And then AMD, 69% gain plus yield. So we're going to put 1,372 in that one. AMDY is 47%. So we're going to put 927. This is TSYY, gives us 43%. So we're going to put 861 in that one. And TSLA, 35%. We're going to put $698 in that one. And that's going to give us, at the end of the year, a gain plus yield of about 133%. Holy cow! That's based on past performance. Past performance is not necessarily indicative of future results. But if these markets perform similarly to what they did last year, which it's leaning heavily on Palantir to do that, obviously. So we got a heavy leaning on Palantir to do that type of a return. But you know what? If it did 300% last year, maybe it'll only do 100% this year. Oh, gee, that's bad. Right? See what I'm saying? See what I'm saying? Okay, now we're going to come in here and we're going to go in. And now let's say that we've got our little portfolio here. And this is our, I don't know if I can do that. Let's go see if we can. So now we're going to come in here and we're going to go to our group calculator. And we're going to say, yeah, it's not going to let me do that because that's not real money. Set the targeter. Ben's going to have to show me how to do that. I'm not sure if I can do that. What I wanted to do is see how much, if we put our 10,000 in here, we could go over there and then next month if we have another 1,000, let's say we get $1,000 in dividends, we put another $1,000 back into the market, we could hit that next little calculator, the group calculator, and it will tell us how much, where to put based on what the market's been doing to maintain this return that we're shooting for. It'll tell us where to put our money. It'll say, put more in Palantir here, put more in AMD, put more in TSYY. It'll tell you where to put your $1,000 next month, and it'll do that too. That's what the next step is. All right. That's pretty cool, man. That's pretty cool. So that's how we build ourselves a little portfolio. You got all the little tools there. You got all the resources. The only one we didn't look at, and I wanted to look at, was Roundhill. Roundhill ETFs. All right, we're gonna have to go to Google. Roundhill ETFs. There they are. So it's roundhillinvestments.com/ETF. So here's the Roundhill ones. All right. So we did the yield max. That's the yield max. Here's the Granite shares. These are the put options. And then we're going to do yield max. Now, yield max, or not yield max, Roundhill. So yield max, Granite shares, Roundhill. Roundhill, okay, we're going to accept your cookies. A little bit more conservative. All right. So they have some in here. Now, they were when I was using them. And they've gone crazy. Look at this. Well, this is all of them. We got to do just the income. There we go. So there we go. Okay. QDTE. I had some of that one for a while. And XDTE. I think those are the only two they had. I think those are the only two. I can't remember. And now they got a Bitcoin one. This is the Russell 2000 Magnificent 7 Maggie. Oh, I think I had some of that one. Let's go look at their Maggie. All right. MAGY. This is the 0 days till expiration covered call strategy. That one there is not so bad. Let's go look at them. All right. So we're going to go take out your piece of paper and pencil. We'll do this the manual way first. We're going to go QDTE. So this is a 0 days till expiration covered call strategy. So they're doing exactly the same thing as yield max on that QDTE. But they're doing it. With 0 days till expiration, whereas yield max does longer than that. They don't do the 0 days till expiration. I don't think they tell us. It's kind of their secret, but I don't think they're doing 0 days. That's these guys, QDTE, and then the other one we want to do is Maggie. All right, MAGE. And we should actually compare it's MAGY. MAGY. We should compare Maggie. That's what we should do. I'm going to leave QDTE to you. You guys can do QDTE on your own. We're going to do Maggie versus MAGS. MAGYS. And that's from Yield Max. So they have one called MAGS. And it's right here. Oh, it's called YMAG. YMAG. All right. So those are the same. That's the Magnificent 7. So it's the 7 big monster tech companies: Apple, Amazon, Netflix, Google, Tesla, et cetera, et cetera, et cetera. Right. So we got YMAG and we got Maggie. Those two do exactly the same. They trade on the exact same companies. They just do different strategies. Let's go compare them. All right. So what we're going to do, come over here. We're going to pull up YMAG. This is the yield max version, and it's trading at we're going to say $15.09, and we're going to look right here, and it's 13 cents per week, 0.13, and we're going to go over to Maggie now, MAGY, which is the Granite shares version, or no, the Roundhill version, and ooh. They had a big drop right there. So we're going to say that they are trading at $55 a share, 85, and pop up there. And they're giving 37 cents. 37 cents. Let's go look and see which one is better. Okay, so now we're going to come over here to our little calculator. We want this one here. And we're going to come in here and we're going to refresh that, clear those out. And we're going to go, so we're going to go YMAG. And YMAG is share price is $15.09, and the dividend amount is 0.13, and it's paying weekly. Everything's paying weekly now. And then this one here is Maggie, M-A-G-Y, and its share price is 55.85, and it is paying a dividend of 0.37, and it's paying weekly. All right, we're going to put $10,000 in there just as a number. Calculate and compare. All right, so YMAG is paying out 44%, whereas annual dividends is 34% on Maggie. So weekly, you're getting $66 versus $86. So it looks like YMAG, the Yield Max Magnificent 7, is outperforming the Maggie, which is the round hill. All right, so that's how that works. So now what we're going to do is we're going to say, well, do we want Maggie or YMAG in our portfolio? Well, since this one's doing a little better, 44% return versus 34% annualized return, we're going to take the YMAG. So now we'd go over to our little portfolio here, Founders Edition. We're going to go back over to our UTU portfolio, and we're going to look up YMAG, and there it is. And you can see gain, -23, that's the blue line. Yield, 47, which is the purple line. So you can see 23%. So let's put that down there. YMAG is 23%. And we're seeing a -23 and a +47. I want to write that down, and I want to look in here just for fun. MAGY. And see how they compare this way. You know what? When you look at it like this, because the gain, see the reason YMAG actually has a lower gain here. They're giving you more of your money back, which means that you're going to get the cash cow a lot faster. But the gain is a positive number on the round hill version. And that's why people like the round hill version versus the yield max version, because round hill is working harder to try and maintain their gain, and they're not having a negative gain. And so that means their yield is smaller. Their yield is smaller, but when you add the two together, you end up with a bigger number down here. They're having 24%. Instead of 23. It's 1% bigger. The difference is that your monthly payouts are going to be smaller. You're only going to get 17% on your dividend. Now remember, you can only spend the dividend. The gain, although looks positive and makes you feel happy, you don't get to spend any of it. So the difference between Yield Max and Round Hill is that you get more spendable cash with the Yield Max. You get more, oh, I'm not losing any money on my blue line comfort from Round Hill. All right. But you don't get to spend that because you don't ever sell it, right, until you're dead. So your kids will get a 6% instead of 0%. But while you're alive, you get less money. Okay. So it depends on what your goals are. How do you feel about it? And if you're just going to try and maintain that $10,000 by putting money back in there, well, these guys just do that for you. So you could do it either way. You still don't get to spend it if you're just going to go put it right back in to maintain your $10,000 up here, right? Get your two buckets, your gain bucket and your yield bucket. If you take the yield, you get a bigger yield, you get to spend it yourself. If you leave it in the market, your kids get to spend it. Which would you prefer? All right. So gain plus yield, this is a bigger number, 24%, but it's stuck in the market. You can't get it out, whereas Yield Max takes it out and gives it to you. It's up to you. It's not. There's no right answer. Which one should I do, Lance? Whichever one you want. But what if I do it wrong? You can't do it wrong. You can only do it different. All right. That's the thing a lot of people don't understand in these financial markets. There's no right and wrong. There's only different. And you don't really know the difference until next year. All right. Well, if I would have done this, I'd have made more money. Yeah, but you didn't know that. If you knew that, you'd have gone and put it all into Palantir. Right. So you do, that's why we call it a diversified portfolio. We do a little bit of a lot of things, and then, maybe we'll hit a really good one here and a little bit less of one here, but we got a nice diversified portfolio, and we try and, shoot the ducks a little bit more than just one duck. So that's the name of the game. So we're going to add Maggie in here. And now, if you wanted to do the growth on this thing, so we've added that into our UTU portfolio. We got Maggie in here. So we're going to get a higher gain, but a less of a yield. Maybe that'll help stabilize our gain a little bit, right? So that's what we're trying to do with the by putting TSLA in there, stabilize the gain of our TSLY and our TSYY. So if we have Maggie, that'll kind of help stabilize the gain a little bit if that's what you're looking for, if you care about that, right? Of course we care about it. We want to have a more stable gain. Less stable gain is no fun. Ask me how I know. Look at Misty. It's not a very stable gain. I mean, it's one heck of a large yield. I mean, the yield's like killing it, right? Let's go look at Misty just for fun. We don't want to put this into our portfolio right now. Well, maybe we do. It's buy low. See, look at this. See, the yield, 109%, but the gain has lost 74%. So I'm really only making 35% on my money. Only 35%. That's why I don't sell it, because I'm like, well, I'm still making 35%, and the chances that we might get a reversal and a turnaround in Bitcoin might go up. Well, if it does, then we'll be okay. We'll make money next year on Bitcoin. This year has not been good for Bitcoin, but maybe next year will be. I don't know. The administration is supposed to be starting to buy some, creating a little fund in there to stabilize the US dollar with Bitcoin, and I think they're doing both gold and supposedly they're going to do Bitcoin. We'll see if they do. Who knows? Nobody knows. All right. So that's what we do. Come in here, making 35%. That's why I haven't sold it. Still making 35%. Is it my big winner of 105? Yeah, on the dividends. Still pulling in 109% on the dividends every month. I get this big old dividend. Do I care about this? Yeah, when I die. Ben cares about it. Janice cares about it. But do I care about it? Not really. You know, when it gets that bad, you start to wonder if maybe you should roll it into something else. But still, 35%, even on this one, is as good as many of these, like AMD. You know, that's about all we're getting on AMD. So that's why I struggle with this stupid MSTY. Just hang on to it for now. I'm making a bunch of money. If I realize that, it's been covered by this, so it's not like I'm losing money. Just not making as much as you would like. And this looks ugly. But looks are deceiving because I'm still making 35% return. If I went down to Cash Valley Bank and put it in there at 5%, 5, 10, 15, 20, 25, 30, 35, 40, 45, 50, 55, 60, you know, how many years? 5, 10, 15, 20, 25, 30, 35, 7 years. Take me 7 years to put that money into Cash Valley Bank and get the same amount of money I'm getting in 1 year here. So whatever, it is what it is, you know. So that's where our UTU portfolio ended up. A little bit of TSYY, a little bit of TSLY. Let's come back over here and we'll look at our performance on this thing. Let's run it one more time. We're going to do yield 10,000, yield plus gain. And there's where our portfolio's at. It's saying we should put 223% or $4,000 into Palantir. Maggie, look at that. It broke it down. So we put $458 into Maggie. Jay's saying he put a little bit of money, pulled a little bit of money out of Ulti and put it into TSYY, make 50% more on the same amount of money. So that's called a roll. So that's what we do. It's kind of the same thing like we call it when we do options, right? You roll your options. You roll it out of one option and into another one. It's got further out. Jay just did a roll. He rolled from Ulti into Tesla. All right. And he says that's going to give him a calculator to be a 50% more on the same money. So that's how you do it. You roll up from one and roll it into the other. If you just take your money out, well, you didn't roll it. You just took your money out. If you take it from one and put it into another, that's called a roll. And that's called a rebalancing of your portfolio. And so when you come in and you rebalance your portfolio, then your little chart, let's see if we go to group performance. That's where that's your little chart in Portfolio Matrix going to do one of these little jigs and jogs. That's what happened to me, right? I did a rebalance right here and my dividends went way up because I went into much higher dividend paying stocks. But my volatility went way down, or I went way down on my growth because my dividends went way up. So kind of expect that, Jay. Watch to see if Ulti versus Tesla, if you don't get a little bit of this and then a bigger growth here, but a little bit more of a drop on your over here. We could go run out of time, but we could go compare those and do a little comparison and see what you can look forward to on that expectation, on that roll. I'm sure you've already done that. All right. All right, guys, there's our little UTU portfolio for right now. And that's where it's saying that we should put our money. Let's go targeter again. So it's saying, oh, I got to hit, let's, okay, so that's what it's saying. If we have PLTR, PLTY, AMD, AMDY, TSYY, TSLA, and Maggie, we're going to put our money here. But remember, this money right here isn't going to bring you a monthly income. You're going to have to eventually sell that, sell your shares to realize the gain on that one. That's the same with, actually it's PLTR, yeah, PLTY. So same with this one. See, it's estimating a gain plus yield of 69%, which is all gain because there is no yield. Putting $1,300 in there to get that 69% anticipated annualized return, you're going to have to sell your shares because those don't have any dividends. And then Tesla, same thing. If we're going to put money into Tesla, $666 to get any profit off of that thing, you're going to have to sell those shares at the end of the year to realize any profits. These others, they're going to pay you throughout the year. So these are pots of gold at the end of the year versus pots of gold at the every month, every week, actually. And it depends on how you want to get your money out. All right, there's our little portfolio for Utah Tech University, and we'd have no classes this week. We can have startup classes again next week. Tomorrow we're going to do a, for those of you who are part of our day trading class, which I'll give you another shameless plug, that's what's coming up. Next week, we start our day trading, our technical analysis class. I know a lot of you guys are in the technical analysis class, and we're going to be learning about indicators and recurring price patterns, and we apply that to a smaller market. We apply that to a day trading style market. Not that you can't use it on these funds, and we certainly do, and I'm going to show you how to do that and how we can use technical analysis to help us decide when to buy low, sell high. And that's what it's all about. And we're going to apply that to day trading. So if you guys are interested in a little bit of day trading, come and join us. Actually, I think the class is sold out. So there's no seats left. But we're still doing the options class. And I think there's still some seats left in the options class first week of December. All right. So that's what we'll do. And on Monday, tomorrow, the point I was making is tomorrow afternoon at 1 o'clock, we're going to go in and we're going to do a little day trading. And we're going to do that on Power Hour. All right. So that's at 1 o'clock in the afternoon, tomorrow afternoon. And we will see you guys tomorrow afternoon at 1 o'clock for Power Hour, 1 o'clock Mountain Standard Time. But before you go, this guy right here has something very important to tell you.
Look, folks, I was reading this thing, Pitt News, right? Great stuff. I mean, back in Scranton, we had newspapers, but they didn't have, the thing with the facts. Claire Christensen, she gets it. Sharp gal. Reminds me of my Aunt Margie. Could parallel park a Buick with one hand. Subscribe.
All right, subscribe to Pit News Magazine because we would never use AI to get celebrity endorsements. Not on this channel, never, ever, ever. So go ahead, get that Pit News Magazine. And
hey, Land Turner here. I got a hot stock market tip for you. Subscribe to Pit News Magazine. You can thank me later.
All right, guys. We will catch you later. Have a good afternoon.
All right, that wraps it up for today. If you got something out of this, do me a favor. Like the video, subscribe to the channel, and share it with someone else who's trading or learning.
Hey, don't forget to tell them to subscribe to Pit News Magazine.
Oh yeah, definitely subscribe to Pit News Magazine. You'll thank us later.